All right, can everybody see my screen?
Yeah.
All right, Mo comma Sunday service. I'm Mo Stacks. I am an attorney that also invests in my off time and trade, right? So today we're going to be talking mostly about interest rate cuts. We are talking about interest rate cuts because this is what pushed the market last week and was the biggest news. Um, and you know, this is extremely important to follow the Fed. The Fed is extremely important in setting monetary policy, and depending on how expensive or inexpensive it is to borrow money, that affects a lot of companies in the stock market. So this was the big thing that happened last week, and we talked about this last Sunday. What did I say? I said if they cut by a half a point, then we're gonna see some bullishness out of the market. If they cut by a quarter point, then either the market was probably either going to go down or stay flat, right? And what did they do? Everyone was surprised when they cut by a half a point. We initially got that tick up. We got some Fed speak that kind of pushed us down, but the next day we were off to the races and a lot of the tech names, right? Um, so, right, that was the news, the big news last week, and it was a half a point. And so the next big catalyst for the market, I believe, is going to be not necessarily if the Fed continues to cut rates, but how quickly they are going to go. How aggressive are they going to go? Um, Everyone thought, if you looked at the CME Fed Watch tool before last week's rate cut, that they were only going to cut a quarter of a point. But cutting by a half of a point is sending a message that maybe the economy is not doing so great under the hood, and that they feel that they need to cut interest rates by a greater amount. And if that's the case, that's going to be great for stocks, especially like tech stocks or things that need money to grow, companies that need companies that need to borrow money to grow. Even for you and I, like car loans are going to be less expensive. Credit card debt is going to be less. Your 22% rate might go down to 20% depending on the rate, right? For credit card debt, mortgages. Right now, your average 30-year mortgage is sitting at like 6.9%. If they cut by a whole point, that might be 5.9%. And you and I know that people who invest in real estate are more likely to invest more money if interest rates are lower because they're more concerned about their monthly payment, right? So the Fed is doing this to spur economic activity, and that's where the saying goes: "Don't fight the Fed," right? And we're still in September, so I'm still cautious from a seasonality standpoint. This is typically the worst month of the year for stocks. So I'm still not putting a bunch of size on trades right now, even though the Fed is signaling that it's going to continue to cut interest rates. Um, Here's a tool that you can use. It's called the CME Fed Watch tool. If you Google that, and it's just showing you like what the probability is for rate cuts in the future, right? So we just had our September rate cut, but if you look here, the next meeting is November 7th, 2024, the next Fed meeting. And our current target rate, since they just cut by half a percentage point, is 4.75 to 5%. Right now, everyone believes that at the next meeting, that there's a 48.6% chance that they're going to cut by another quarter point. And then another 51.4% believe that they're going to cut by another half point at the next meeting. So it seems to be that there's a consensus that the Fed is going to cut rates. The issue is just how much are they going to cut? So, if and this is for you in your personal life, I know me. I'm looking at properties in Cleveland right now, as well as getting a potential SBA loan to grow my firm. I'm going to wait if I see that there are rate cuts on the horizon where the loan that I get, the rate's going to be lower, right? So, um, there's almost right now the market is pricing in 100% chance of a rate cut in November, but they're split on whether it's going to be a 0.25% or 50% or 0.5%. And then in December, same thing, right? And this is how you use the CME Fed Watch tool. So let me go back really quickly. You see here, our current rate is 4.75 to 5. And this is the money, and I want to be accurate, and I'll probably get this definition, but the Fed rate is the money at which the Fed banks loan to regular banks, right? And so if the target rate is 4.75 to 5%, and let's say the federal government is loaning money to banks at 5%, they're going to charge you and I a couple of extra points for the mortgage, right? So the mortgage rate will be 6.9 or 7%, even though the target rate is 5%, and then the bank that you're getting money from, that's lending you money, is making that 2 points off the spread, right? So most loans are tied to the Fed rate, which is why this is really important when the Fed is either lowering rates or hiking rates or keeping them steady. When you're looking at this particular tool, if you see what the current rate is, and now we're going out to December, right? Our current rate is 4.75 to 5. Most of the market believes that we're going to have at least two more rate cuts before the end of the year. 25% believe it's going to get cut to 4.25 to 4.5. 50% believe that it's going to be 4% to 4.25%, and 24% of the market believes it's going to be 3.75% to 4%, right? So right now the market is primarily pricing in two more rate cuts before the end of the year, and then some believe, or half believe, that we're going to get two half-point cuts that might get us down all the way to 4 to 4.25% by the end of this year. So for me, in terms of myself getting loans, I'm probably going to wait until we get into the end of December into January, because what I don't want is a higher rate on a particular loan that I might get, and then rates are going to get cut over the next couple of months, right? This also, and I don't want to get political on this show, but this also is probably going to help the current administration. And what do you know, that rates are getting cut right before the election? Crazy how that happens, right? So the rates are going to get cut, which is likely going to push us up in terms of the market, and that's going to be great for anyone who has IRAs, 401ks, things of that nature, right? So that's the first thing that I wanted to talk about, is the Fed. If the Fed is lowering interest rates, that is going to spur greater economic activity. And if there is greater economic activity and more people are hiring and more people are spending money, that's likely going to push the market up. What's going to suffer potentially, and what we were talking about, is maybe some of the safety stocks. At least as we're coming into the end of the year, if the Fed is signaling that it's going to cut rates more, people are going to be more interested in the small caps and the Russell, the IWM, and then tech stocks may grow a little bit faster. Come on, baby, I need you to be quiet. Okay. All right, and then so just in terms of looking at how the market reacted in real time, right? So the ES is the S&P 500 futures, the NASDAQ or the NQ or the NASDAQ futures, right? So if we look at this green candle right here and this green candle right here, can you guys see my screen?
Yeah.
Okay. So these green candles is right when they announced that 50 point, that half a point rate cut, 0.5. Then we got a tick up, which kind of gave you like an indication of how the market liked it, right? Same thing with the NASDAQ, which is mostly tech stocks, right? S&P 500 is more of a balanced index with a bunch of everything in it, right? And then here, if you look at where my arrow is in these two candles where we start coming down, that's when Jerome Powell started speaking. So this is why I tell you guys not to trade around these volatility events, because even the good news took us down that day because the Fed chair came out and spoke and said something that the market didn't like. And you see how that reacted on the NASDAQ too. Now let me go one slide forward. Same thing for the Dow. That spike up, Fed chair started speaking, we started coming down. Same thing on the Russell. Spike up, Fed chair started speaking, then we started coming down. Right? So, like, that's if you're trading around these events of volatility, maybe give it a day, give it 2 days, because even the direction that we might end up heading, if you were looking at the market on Thursday, we took off, right? So if you had my long-term positions did like amazing on Thursday after the rate cut announcements. We took off on Thursday, and a lot of tech. And in my long-term and my IRAs, I own a lot of tech. So I was happy that that happened. But if I were trading around a lot of this, and I did have a couple of positions that had been existing on, and I got out just because we had a lot of volatility surrounding a lot of these announcements, right? So just wanted to show you in real time. If you go to a 5-minute chart on Thinkorswim or whatever your platform is, that's really what I'm looking for. It's like I don't even care what the number was. They could have cut a whole point. If the market went down, I want to know how the market's going to react to what they're doing, right? So at first we went up, then Jerome Powell started speaking, then we went down, and then the next day we took off, right? Um, next, let's talk about my weekly stock picks. And when I say my weekly stock picks, I am not talking about go buy these things on Monday. Go buy these things on Tuesday. If you know my strategy is to catch strong things, trending names on pullbacks. So if I'm telling you these are my stock picks, then I want to buy these names on down days because things don't tend to go up and up and up. Sometimes they do, but they tend to go up, up, and then check back, and then go up, up, and then check back. So I'm waiting to buy these things on checkbacks, right? So if something strong has a bad day, that is when I'm looking to get into that particular name. If it hits a certain daily price movement range, an ATR, or a certain moving average, an exponential moving average. I don't really use simple moving average. I use exponential moving averages, right? So how do I find my watch list and my hot sectors? There's a free tool out there, and I keep emphasizing that it is free. Koifan. They do have a paid version, but it is a free tool out there where you can go check what sectors are performing really well. And what I tend to look at is what's performed well over the last month. Sometimes I'm looking at the last week. With my day trading, I might be looking at the daily. But I'm looking for what's been trending, what's strong. If you look at this equator right there, this dotted black line that goes across, right? What I'm looking for in terms of going long on something for a swing trade, and I typically prefer swing trading over day trading. Um, Day trading is more of a shorter time period where you might be in a trade for less than a day. Most of my swing trades are longer than a day, up to about 3 weeks, depending on the circumstance. But I'm looking for the sectors that are above this black dotted line. Oh, let me go back. And that's what I'm looking for on a pullback, right? So, what are our trending sectors over the last 30 days? And then also, I might go month to date too, because, sometimes when you change over the month, so I kind of want to see what's hot month to date in this new, especially if we're in a new month. Like if the sectors are rotating, people are rotating into a different sector. And then what's hot over the last month, we get close to the end of the quarter. I might also do quarter to date as well. And then I want to see what sectors are consistent in maybe those 3 time frames, right? So what's been really consistent? XLU. And if you've been in the chat, you know that I've been talking about the safety trade might be coming to an end. But as I said that day, the next day XLU took off again. So I don't know. And I try not to trade on my feelings. I try to trade on data. And the data is telling me that XLU has been the strongest sector over the last month. So if XLU pulls back, that might be something I'm interested in. XLY, which is the consumer discretionary, I believe. Yeah, they're consumer discretionary. XLI, which is the industrials. KRE, which is a heavy part of the Russell, but mostly the regional banks. XLF, financials. Building materials, I don't usually trade XLB because it's not really liquid. Gold miners. Isaac, mute yourself. We can hear you. GDX or gold. And XLP, I'm kind of like falling off on, to be honest. But that's what's been strong, right? And even all the way down to XLC and XLV, right? So, Isaac, mute yourself. I can hear you. So, in terms of the hot sectors, once again, just from pulling from Koyfriend, we're not just talking about the sectors, but we also are talking about the things inside of that particular sector. In order to find out what's inside XLU or any other ETF, let me go back. Most of these names right here.
Oh, you're killing me.
Hold on.
You're killing me.
Hold on. Isaac. Hold on. Crazy. Let me see how I can mute this guy.
Baby.
There. All right. So, in terms of hot sectors, we have everything above this black line. Everything that we're talking about right now is an ETF. So an ETF is like an all-star team of stocks. So all of these names right here, when we're talking about sectors, are ETFs. So in order to find out what's inside of an ETF, all you have to do is go Google XLU Holdings, KRE Holdings, XLK Holdings, whatever it is, right? And then go figure out like what's weighted or what's heavily weighted inside XLU. If you were with us last week, XLU, I had NEE there as well. I don't have NEE there this week, which is the most heavily weighted in XLU, just because I didn't like how the stock looked, right? XLU still looks really good from a trending standpoint, right? So what do I mean is a stock trending, right? So Koyfin is kind of like a cheat code to go figure out if a particular sector is trending, but you should be able to also go look at the chart and see if it's trending as well. So I usually use a day chart for this, right? So if I'm on a day chart, meaning that each candle is a day, I'm looking to see if these moving averages that I have on my chart are going from the bottom left of the screen up towards the right, right? So if you know how I set up my charts, my green is a 21 moving day average, exponential, a 34 EMA, a 50 EMA, and a 200 EMA, right? And so what I'm looking for is to see if the smaller EMA is on top of the larger EMA. And if that's the case, that is indicative of a good trend. And this is what I was saying with XLU, right? When the Fed announced rate cuts, we came down and then we gapped up the day before and made a new high, which tells me, F my feelings, right? I need to pay attention to the chart. The chart is telling me we're still making new highs, so XLU is still strong. What I should have done, and the reason why I didn't take this on Friday, is this is the type of move or the type of candle that I want to get in on, is towards this low, right? A pullback on something strong. I did not get in on this particular trade, even though my alert went off, because we were coming up on options expiration on Friday, which is another volatile day. And I don't like to trade too much on options expirations, right? Because on the third Friday of every month when options expire, we tend to have a volatile period like we had today or that day where we had a gap up on XLU. But I do still like XLU. It's been strong consistently over the last month or so. It's been trending upward. So I would like to get in on XLU on a pullback. NEE, which is heavily weighted in XLU, I didn't like the chart, didn't look like XLU. So I took that off my watch list for this week specifically, right? Another hot sector. This was the number 2 hot sector was XLY. XLY is heavily weighted Tesla or Amazon, but I am not trading Tesla or Amazon because for some reason their charts don't look like XLY. The charts that look similar to the sector are McDonald's, Lowe's, and Home Depot. And I reorganized them in this order because I feel like McDonald's and Lowe's are stronger than Home Depot, right? So here's XLY. Same thing, not as strong of a trend as XLU, but we're trending upward now, right? So I would probably prefer to trade McDonald's, Lowe's, or Home Depot over XLY if they pull back, just because those trends and those names are a little bit stronger. The reason why XLY's trend probably isn't as strong is because Tesla and Amazon aren't as strong as the other things in XLY that are a little bit less heavily weighted. But if you look at McDonald's looks relatively strong over the last month or so. So same thing. I wish I would have got in on Wednesday or Thursday, but we had a Fed meeting on Wednesday and options expiration, so I decided not to trade heavy last week. But if you look at this stock, right, same thing. We had these lower moving averages crossing the longer moving average, heading up from the bottom left to the right. So I like McDonald's on a pullback. If it comes back down to like where it did on Thursday or Friday or to a daily price movement range using a tool that I pay for or an ATR, that's what I'm looking at on McDonald's. Same thing with Lowe's. Trend looks pretty strong, heading from the bottom left up to the right. The lower moving averages are on top of the larger moving averages. If we can get this on a pullback as well, either to a daily price movement range, to a moving average like this 21, or to an ATR, that is something that I would think about getting in as well because the sector is strong and trending upward. Same thing with Home Depot, except Home Depot looks like it's been choppier. So I would probably wait for a greater pullback on Home Depot looking at how choppy it's been. But it's been trending up over the last month or two, right? Lower moving averages on top of the greater moving averages. So this is how I'm finding my targets, right? So that's XLY. That's consumer discretionary in terms of the sector, right? So the next hot sector, we have XLI, which is industrials. And what's crazy about this sector, it's tied to the Dow a lot, right? But you would think industrials would have something to do with like industrial names, right? So, but XLI, some of the heavy weighted stuff in there, like GE is an industrial name, but then you got Uber in there. I think Caterpillar is in there and John Deere, which I guess makes sense, but it's kind of this weird aggregate, if you ask me, anyway. All right, so XLI has been strong. The only other name that I'm interested in that sector, I didn't like how Uber looked. I didn't like how Caterpillar looked. The only thing I really liked the chart was GE. Just showing you XLI's chart, same thing. Lower moving averages going from the bottom left up to the right, especially over the last month or so, which is what Koifin told us, right? Koifin is telling me which pond to look in, right? And the longer moving average or the larger one is underneath the shorter moving averages, right? And so same thing here. I want to wait till we have a significant pullback and then take it to the upside because we're making higher highs. That means the trend is strong, right? And then higher lows. Low here, higher low, right? Trend is strong. So I like this sector as well. The best name, if you ask me, has been GE, right? It's trending upward. I might actually prefer to take XLI over GE itself, but a lot of times there's problems in the options market with XLI liquidity. And if you know me, I don't tend to take my trades with actual shares of stock. I'll take it with, if I'm going long, I'll take it with some calls or with a put spread. And GE tends to be more liquid than XLI. At least that's been my experience over the last few months. So that's why I might look to GE instead of XLI. And GE is kind of has this upward range similar to XLI. So that's why, when I say does it look similar, look at these last probably 7 candles on GE and look at the last 7 candles in XLI. They seem to be tied together pretty well, right? They look almost exactly the same. So that's what I'm looking at in terms of these two. The sector is tied to the stock, right? So I would feel comfortable if XLI is not liquid, and I wouldn't get into that stock or an option in that stock. But I would rather buy GE because it's more liquid and it's probably going to move similarly to XLI. All right. Next one, financials. But when I say XLF, we call it the financial ETF, but it also has other things in it like Visa, MasterCard, and American Express, the credit card companies, and even Berkshire Hathaway and some insurance companies as well, right? I think Progressive is in there and some big insurance companies. So even when they're saying the financial sector, they're not just talking about the big banks like JP Morgan, Bank of America, Citi, Wells Fargo, right? They're not just talking about the big banks. They're also talking about credit card companies. And the credit card companies are the ones that have been hot lately, and that's what's been pushing XLF up. So I actually would rather be in Visa, MasterCard, or American Express over XLF if they pull back. But recently, a lot of these things haven't been pulling back. Well, until, what was it, Wednesday, Thursday, Friday of last week. But these things have been taking off, which is why they're kind of probably my favorite targets for next week. Looking at XLF, same thing. Lower moving averages on top of the longer moving averages. Look at Visa. Visa took off since what, mid-August. Visa's been taking off. We finally have a pullback on Visa, right? So like Visa's probably close for an entry point, and it's been XLF. The sector has been strong over the last 30 days, but Visa has been incredibly strong, and we finally got a pullback on a strong name. Look at how parabolic it went. This is something that's finally cooled off. So if I see some more weakness on Visa, I definitely want to enter Visa. MasterCard looks very similar, except it's been a lot, been a lot smoother. But same thing. It's been heading up. If you would have got in on this, and just to show you in terms of my strategy, so it starts trending here. You got in on this pullback, you would have done really well, right? Sold somewhere up here, at least half your position somewhere, and then let's say you got stopped out, and then you got in on this pullback, you would have did really well again, right? And if you would have got in on this pullback on Thursday, you would have been brave to get in right before options expiration, but you probably have a good chance of doing pretty well, right? I'm looking forward to get back down to that low right there for another potential entry. But that's where you want to grab, at least as far as my trading strategies, to grab these stocks at a point of exhaustion, where they're something strong at a point of exhaustion that's likely to head back up. Same thing for American Express. I would say this is my least favorite target because the trend isn't as strong, right? You do see this heading upward, but it's more flat than MasterCard, which is more parabolic, and Visa, which is extremely parabolic, right? So that's kind of the order that I would take these. Like if they were all triggering at the same time, I would take Visa over MasterCard over American Express, right? But I would be comfortable trading any of them. All right, next, gold. I took GDX off this list, even though GDX is also a trending name, just because of the volatility. Gold itself, in terms of the futures or GLD, the ETF that's pretty much trades off the futures, are more steady, at least for me. Like I like the steadiness of it versus GDX wicks up and down, right? So and and I guess I'm biased because I've had a couple of good trades off of gold over the last couple of months. So same thing. Gold has continued to be strong. You keep seeing higher highs, higher highs, right? And the lower moving averages in terms of the shorter periods are on top of the longer moving averages. And GLD, I mean, this is why I say it trades similar to the futures. Look, the chart looks almost exactly the same. It's not going to trade exactly like it, but it's going to trade based off how the futures, right? And the futures are just open longer, which is why I watch them. Futures are open 23 hours a day typically, while most ETFs and stocks are only open from an East Coast time of, what is it, 6:30? No, my bad, 9:30 to 4. West Coast time, or PST, which is our time, is at 6:30 to 1, are when most stocks are open for trading. But futures are open all the time. I don't trade futures. I usually trade options, but I know that most futures have an ETF alternative. So the ETF alternative for the gold futures is GLD. So I'll typically trade the gold futures off of GLD specifically. Even when I'm entering, I'm going to be using GC to enter, but I'm actually going to be trading GLD. All right. Next hot sector for me, in terms of what I'm looking at on my watch list, I'm actually in a trade right now that I got into Friday on Abbott Labs, right? XLV, which is the healthcare sector, Abbott Labs and J&J. Lilly is the heaviest weighted in XLV, but it is not on here because I did not like its chart. It's not trending. And so if it's not trending, I'm not going to look at it, even though it's the most heavily weighted inside of XLV. The two trending names that I saw inside of XLV are ABT and J&J. So if you look at XLV, same thing. It's been trending. Shorter period moving averages on top of the longer period moving averages, right? On a daily chart. All right. Look at Abbott Labs. This is what I got in on Friday on this candle right here towards the bottom of the candle, right? And if you see my strategy, my trading strategy is to get in on a pullback, right? So this has been trending up, came back, and then I entered on Friday in this candle towards the bottom on a pullback, right? Towards this, hitting this 34 exponential moving day average almost, right? Definitely came down past this 21. That's kind of like an ideal setup for me. Something that's trending and a sector that's also trending, right? Because the sector is trending. So, and a stock that's trending and a sector that's trending that's pulling back. And J&J actually kind of did the same thing, but I like ABT better because it's more parabolic. It looks like the trend is stronger in ABT over J&J, but I will also be looking at J&J for next week as well, right? Because it's trending and looks very similar to XLV in terms of how it looks, right? All right, so that's everything on my watch list for this week. Just to kind of recap though, what am I looking at this week? XLU, XLY, McDonald's, Lowe's, Home Depot, not Tesla or Amazon. XLI, GE. XLF, Visa, MasterCard, American Express, not the banks. Gold, specifically the futures, if you trade futures, or GLD, the ETF alternative. And you could trade GDX, but just be prepared for more volatility. XLV, Abbott Labs, which I'm currently already in a trade in Abbott Labs, and Johnson & Johnson. And in terms of next week, so this is the last part before we talk about specific stocks that anyone is potentially looking at or wants to look at. We have a lot of Fed speak next week. And if I just showed you the chart of what happened when Jerome Powell started speaking, it took an up day on the actual day of the rate cuts announcements to being a down day. And it's because the Fed can move the market. We have an unusual amount of Fed speakers speaking next week. On Monday, we got 3. On Tuesday, we got 1. On Wednesday, we got 1. On Thursday, we have 10, including El Jefe himself and Secretary Yellen will be speaking. and she can move the market as well. And then on Friday, we got one more person and GDP numbers. So don't be shocked if we have a little volatility around some of these Fed speakers this week, specifically if you are day trading. If you are day trading, meaning a trade that you don't expect to be in longer than that day, then you need to know what time these people are speaking, because you might want to cut your trade right before they get on the podium, or you might want to wait for a pullback or a pop in the market to short when they do get on the podium and say something really stupid or something really bright. It might move the market one way or another, and you might want to wait until they speak or get out of your trade before they speak. Otherwise, like, you're going to be dealing with some potential volatility. And the Fed chair did say this last half a point cut that there was some dissension in the ranks, that everyone didn't think that they should have cut a half a point. So that may move the market, because there's half of the people in the market right now are betting that they're going to cut another half a point, and there's half of the people that think they're only going to cut a quarter of a point the next meeting. And if they cut another half a point, that's more bullish for stocks, especially small caps in the Russell and tech. If they cut a quarter of a point, that means they're going to go a little bit more slowly, right? So that does affect kind of like where we go in terms of the end of the year. If they cut another half a point and we're in an election year and we're coming out of September, we could be off to the races in terms of the end of the year, right? So people are going to be watching at how hawkish or how dovish these speakers are next week to figure out where we go from here, because the market is always forward looking. It's pricing in certain things already, but now we need to know what's the next rock to turn over, and what's next, and how fast are we going to go in terms of interest rate cuts. Who knows? Another thing to look at would be any jobs data that comes out next week. And that's why I say GDP too, because if the economy looks weak or we get some weaker jobs data, they might cut another half point cut, because they want to go a little bit faster to make sure that we don't have a recession coming into next year. So those are just some things to look at, and just understand when rates are being cut, that is bullish for most stocks in the market, with the exception for a lot of safety stocks, or the things that people go to when they're scared the market's going to crash. Also next week in terms of earnings, Micron, they are a chip manufacturer on the semiconductor side. So in terms of what the sector is going to do on the 25th, if Micron reports terrible earnings, that could potentially bring down the chip sector or SMH or anything in it sometimes next week. If they report really great earnings, it could boost the chip sector. Costco is another one in terms of consumer staples. Not just XLP, but just I feel like Costco is a good barometer on the economy. And I actually own some Costco in my long-term portfolio, but it's a good barometer of the economy too, in terms of how well the economy is doing. If Costco is doing well and is growing, then chances are that people are still spending, right? All right, folks, that is the end of our visual presentation today. Does anyone on the Zoom have any questions? Anyone? Yes? No?
No, not at the moment.
It was good, man. Good presentation, Mo. Appreciate you as always. So just a couple key points. We're going to look out for the Fed, some more announcements as far as if they're going to be dropping some points. And then as far as you did point us in the right direction as far as different stocks to look at. So I don't have any questions as far as that.
All right. So the one thing that I wanted to do is to like show you, okay, so let me go show you how I actually trade. And I'm going to take the trade that I entered on Friday. All right. So I'm going to pull this 5-minute chart over, because I'm usually using for my swing trades, not my day trades. If I'm day trading, I'm going to be day trading mostly off a 5-minute chart. If I'm swing trading, I'm mostly going to be swing trading off an hourly chart or a daily chart, right? So if I go type in Abbott, right? So I got in on Friday, right? Close to my range to get in was between, I think, like this level and $113. I actually had another order sitting at $113 that didn't get filled because it popped before it got there, right? So if we go to an hourly chart, yep, I remember these levels right here. I got in, I think, on, it was either this candle right here or this candle right there. Probably this candle, right? No, maybe it was earlier in the day. I don't know. Actually, I don't know. It could have even been this candle right here. The minute it dipped below this line right here, that was where my order was sitting, and I either got in on this candle or that candle, right? And so this is kind of how my chart is set up. I usually even have a daily price movement range tool, but it's only programmed for certain stocks, and Abbott Labs isn't one of them. But what I like to see, and I looked at the chart, is that we are trending upwards, right? This is a different representation of a 34-day exponential moving average. And something that has been really strong, and Abbott Labs is decently weighted in XLV. XLV, as from what I showed you in the presentation on the chart, has been relatively strong and trending too. And then I see two big down candles. My candles are going to look different than your candles. Typically, these would be red candles. But for me, my candles, same company I bought my indicators from. If there's a trending stock, it won't necessarily make a candle red. It'll keep them green. It just will be a darker green instead of a brighter green because it's based upon volume as well and the trend. So just because we have a down day or two doesn't mean that the trend is over. It just means we had a pullback, right? And so my chart and the candles that I use are more representative of that. So just because, yes, this is a negative day, 2 or 3 negative days, but doesn't mean that this is a bad stock to enter or that the trend isn't still strong, right? We still see that it's a decently strong trend. So on Friday, I saw it come in my zone right here. This is where my zone was set. And so I purchased, I didn't take this with calls to the upside, right? I took this with, let's see, ABT. I took the October 18th expiration date. So actually a little bit more than 3 weeks out, right? Because the options were more liquid in this particular expiration date. And then what I did is I actually sold a put spread on this one because I saw there was liquidity at both strikes that I was actually interested in, right? So I sold this put here, which is a bullish trade. Selling a put is a bullish trade. And then I purchased 2 strikes away. I purchased this one here. As you can see my positions, right? Red for sell, green for buy. And it's just to show you how that would look. So I'm using a Mac. I'm not sure exactly what it'd be on a PC. It's probably Control, but you click the first one. You click you click the bid, right? If you click the ask, it's going to want to buy this strike. I'm actually trying to sell it. So I'm going to click the bid, right? And then I am going to click Control on my keyboard and then click the ask. And then that's how I am going to sell a put spread, which is a bullish trade. And that's what I did. I sold a put spread on this when it hit my price. What happened? Oh, click flexible grid. When it hit my price range, that is when I entered this put spread, right? Or when I sold the put spread. So another way I could have tackled that is I could have bought a call. So if my range was between $113.61 and $113 approximately, I could have also purchased a call. The call that I would have purchased would have been one in the money, which would have been at $110 in terms of the strike, because I never go out of the money when I purchase calls or puts, right? So I would have bought this call by clicking that button, clicking the ask, and I would have bought this call. And the reason why I would have been okay buying this call is because if you look at the open interest, it's over 1,000. And that's my rule. I tend not to get into a trade where the open interest on the option is not at least 1,000. So I could have taken that, but the reason why I took the spread is because I prefer to take spreads over options, just buying a call or buying a put, because time decay is in my favor. And so I'll take the same risk in terms of the same dollar amount, but I'm taking a spread instead because it's a less risky trade. Generally, though, in a lot of names that aren't super liquid or aren't mega caps, it's very hard to find liquidity in a name like an Abbott Labs. But here we do at the strike prices that I actually wanted. When I'm taking a spread, I usually like to sell the one that's in the money or right at the money and then go 2 strikes down out of the money and buy that one. That's typically how I buy spreads. And here I found the open interest. There's open interest at that level and at that level. So these two options, one that I sold and one that I bought, are going to be easy to exit because there's plenty of liquidity at those levels. So I decided to take this trade down with a put spread instead of just simply buying a call. Right. Oh, and then I think I forgot to give my disclaimer at the beginning. For everybody on YouTube, this is, trading is risky. Investing is risky. This is for informational purposes only, right? Always direct your trades to your financial professionals. Do your own research. Trade at your own peril, right? Because even this particular strategy that I'm using right now has a 60 to 70% win rate, which means that I'm guaranteed to lose 3 or 4 out of every trades, right? And so psychologically, I'm prepared to lose 3 out of 4 of every single one of my trades. But that means I should win 60% of them, 60 to 70% of them, using the particular strategy that I use. And then I feel like trading these with spreads makes it even less risky because I could stay in a trade for longer. So typically some of the stuff, like if you saw XLV was at the very end of my presentation because it was the least strong. So if I'm trading a trending name that has a lesser trend, I'm going to want to enter that trade in the safest way possible. And for me, the least risky way to enter a trade with options is by selling spreads, right? So, and if you also see, I didn't have anything to short in my presentation. Why? Because let me show you CoinFin again. Let me share my screen. Where's Google? Let me go to CoinFin and show you what I'm talking about. Once again, this is free. You can upgrade. I don't sell their products, but you can upgrade. But their free tool is amazing. Specifically, I go to market dashboards and I go to U.S. sectors, right? And then I check off the sectors that I'm interested in trading, right? And if you go look even at the weak sectors, right, over the last 30 days, which have been semiconductors, oil services, oil and gas, energy, tech. But if you look, they've all, since the beginning of September, they're all heading up, right? I don't really see one downtrend since the end of September, even though these names are still like below zero, right? XLV is actually above it. It's just not enough room, right? Everything XLK and underneath is below zero. But even those names have been ticking up. Look at XLK since the beginning of September. It's been coming up. It's not above this 0% mark yet, but it's still ticking up. Even XLE, even oil. So everything's been decently strong. I don't want to short it because there aren't too many downtrends. So that's why I'm on the long side of the market next week. I'm not really intending to short anything because the market's been relatively strong after this Fed announcement. But another thing I'm not going to do is I'm not going to be taking these weak names long. I want to take the strong names long when they pull back. Right? All right. So I wanted to take you through, well, number one, the Fed and interest rate cuts. Number two, what I'm going to be trading in terms of swing trades next week and why. And number three, the news that might affect my day trading or swing trading next week. And then number four, like how I would actually tackle one of the trades or the stocks that I gave you guys that I'm going to be looking at, and how I would do it with either calls or with put spreads. All right. Any questions before we end today? Anything y'all want to look at?
No, sir. I just want to confirm. So this is not guaranteed that I'm going to be rich.
Not no, and not just that. And then so we're gonna do an episode on this too. Sometimes position management is. I was so pissed last week, and I don't day trade often, but I had a good setup on a day trade that I actually took, and I think I made $200 on it. But if I would have held it for longer, I would have made like $800 on it. And so my issue was I moved my stop up too quickly. I should have just kept it at break even. If I would have kept it at break even, it would have been a monster of a trade. So you got to understand, even with a good strategy, if you have a strategy that you've tested, which you should do, or in my case, I'm in a mastery at Simpler Trading where they test all of their strategies extensively for 6 months to a year, where they could give you like a percentage rate of how often it wins and how often it loses. Like, even if you have a strategy that wins more than 50% of the time, the key is to let your winners run so that you can have a monster trade, right? So if you're losing, your stop loss is 20-25% on an options trade or whatever, and you cut that, when you have a winner, you need to have a winner that's 100%, that's 150%. Like I've had a couple times this year on Pepsi, on Coke, and then I had another one on gold, right? That I had some 100%, 150% winners on some of my trades, because that's what's going to make up for all of the trades that lost, and to get you past just barely breaking even or making a little bit money to the thing that just takes off. The goal is to get to a point to where you're playing with house money, where you can have a break even stop, where it goes in your direction. You take a little bit off the table, maybe take half of your position off the table, and then you just let it ride. And if it wants to go to the moon, you let it go to the moon. But a lot of people get out of their trades too early, right? They're willing to hold their losers and they get out of their winners too early. And it's a psychological thing where we're afraid to lose more than we like winning. So it's like, try to hold your winners for longer and get out of your losers as soon as you know that they're a loser, right? Cut them, cut the loser, keep the winners for longer, right? And then that way, that's how you're going to find more consistent growth. Number two, position sizing. You shouldn't be trading on each trade more than 2 to 5% of your account. Some people like Ian Dunlap for EYL will say 1%. Don't trade more than 1% of your account, because then that means you got 100 times to be wrong. So that if you go on a losing streak, but you got a 60% win strategy, really 6 out of 10 trades you should be winning. So if you got enough bullets in the chamber, you can keep playing so that the percentages are on your side. But if you're doing like 25% of your account on every trade, then you're going to get ruined at some point in time, because it's not uncommon to have 4 bad trades all in a row. And it's also not uncommon to have 4 really good trades all in a row. But it's all about like how you're managing your position and how you're sizing into a trade. And are you scaling into a position, and are you scaling out of a position? But yeah, those are the things that are going to help you be more successful. And then in terms of your long-term account, find a really good stock that you think is going to be around for a really long time, and wait for it to pull back 25, 40, 50, 60% at a level that it tends to bounce at, and get it on discount and hold it for 5 to 10 years.
That's good info. I ain't gonna lie.
Yeah.
All that was great.
Yeah. All right, folks. That's it. If there's no more questions, no stock, and that you guys want me to analyze or go over or anything like that.
No, sir. Perfection at its best.
There could be people in the
more
YouTube.
comments with the umbrellas, baby. Let's do it.
Yeah. And then I apologize if there are people on YouTube in the chat. I'm not really checking the chat. I don't have a secondary screen. If you're interested in coming next week, you're going to need to leave a comment. Go to my website, Mostaxx, MOSTAXXLA.com. Leave me a message, and I can shoot you the Zoom link if you want to actually ask questions or review a stock or anything like that. All right, so until next week, every Sunday, 8 a.m., Mocama Sunday service, making it rain without the umbrellas. I'll see y'all next time.
Thank you.
Yeah.
Peace.
All right, peace.
You did good, my guy. You did good.
Yeah.